Hello dear students, I'm sure you're all very busy with your preparations. So let's discuss the very important adjustments in consolidation accounting standard 21, consolidation of financial statements. Let's discuss one by one. Most of the questions you will find this revaluation adjustment. What is this revaluation adjustment in consolidation? Listen carefully. On the date of acquisition, the parent, the holding company, revalue the assets of subsidiary company. And that accounting effect is not given by subsidiary company. Subsidiary company would have not accounted the revaluation of this assets in its separate financial statements. So when you prepare the consolidated financial statements, uh, the most important step in consolidation is identifying capital profits pre-acquisition profits and identifying post-acquisition profits or revenue profits. It is the most important step. So when you identify the capital profits or pre-acquisition profits, first you compute revaluation profit or revaluation loss. How do I compute? You need to identify information. You need to identify the book value of asset in the books of subsidiary company. Book value of asset in the books of subsidiary company on the date of acquisition and compare it with fair value or revalued figure that will be given. So compute how much is revaluation profit or revaluation loss. If revaluation profit that or revaluation loss, whatever, it is always in the nature of pre-acquisition or post-acquisition. Pre or post. This revaluation profits are always in the nature of revaluation profit or loss is always in the nature of pre-acquisition, because on the date of acquisition there is revaluation. So that profit is considered as pre-acquisition profits, and profits after the date of acquisition only will be considered as post. Okay. So whenever there is revaluation, it always form part of pre-acquisition profits or capital profits. And if there is revaluation, there is depreciation adjustment. There is depreciation adjustment. Whenever there is revaluation, there is depreciation adjustment. So what we are saying, revaluation profits are always pre-acquisition profits or capital profits, and when there is revaluation, always give effect to depreciation. And this depreciation, if revaluation profit, additional depreciation, because asset value increase means more depreciation. Revaluation loss, asset value reduce means less depreciation. Always give the effect to post acquisition P&L. The effect is always in post acquisition P&L. The effect is always in post acquisition P&L. And don't forget to give the effect in consolidated balance sheet. You add holding companies assets, you add subsidiary companies assets. When you add subsidiary companies assets, add the revaluation profit minus additional depreciation, or less revaluation loss plus reversal of depreciation. So sum up, depreciation, do not forget whenever there is revaluation. Revaluation profits is always of pre-acquisition nature, but depreciation is always adjusted in post-acquisition P&L. Are you clear? Yes. Then without wasting time, second one. What is the second one? Unrealized profit. What is this unrealized profit? It is so common that there can be intercompany transactions. What is intercompany transactions? Subsidiary can sell goods to holding company, or holding company can sell goods to subsidiary company, and what is sold is remaining as closing stock, either in the books of subsidiary or in the books of holding company. It is remaining as closing stock. So on the date of consolidation, there is closing stock, and closing stock includes profit element. Profit from where? Profits within the group. holding sold to subsidiary or subsidiary sold to holding. So that closing stock includes profit element from an entity within the group, which requires elimination. Because when you prepare consolidated financial statement, the concept is holding and subsidiary are not two separate legal entities, are single entity is the concept. When we prepare consolidated financial statements, we believe that both companies are single entity, single. So how can then one entity made profit over another? It's like A made profit over A. It's not correct because they are within within one group. So elimination of unrealized profit. So unrealized profit is out of intercompany transactions. Yes, intercompany transactions are divided into two, upstream and downstream. Upstream means sale by subsidiary to holding. Downstream means sale by holding to subsidiary. Whether it is up or down, eliminate URP. And what is the journal entry for eliminating URP? P&L to stock. Debit P&L. If subsidiary sold to holding, subsidiary's profit is more. Holding company's closing stock is more. Reduce P&L to stock. If it is downstream, holding company's profits is more. Reduce holding company's profits and stock from the balance sheet. So if it is uh, upstream, reduce the generally post acquisition profits. Reduce post acquisition profits of subsidiary. Reduce post acquisition profits of subsidiary, which we generally do in step number 3, and reduce the stock in the balance sheet. Okay, clear, clear, clear. If it is downstream, reduce reduce profits of parent company, because parent company's profits is inflated. Reduce the profits of parent company if it is downstream. If it is upstream, reduce the post acquisition profits of subsidiary company. And don't forget to deduct stock in the balance sheet from the total of the stock in consolidated balance sheet. Okay. Now, again, very common mutual owings, but it is not going to be a headache for you. Mutual owings, cancel mutual owings, creditors to debtors, bills payable to bills receivable, or maybe debentures to investments in debentures, due to A, due from B. Okay. And in case, rarest of the rarest, in intermediate level, they are not testing it, but if there is a gain or loss on cancellation, gain or loss on cancellation, that is asset value is 50,000 but corresponding liability balance is 80,000. So we'll be passing liability debit 80 to asset 50 to there's a gain of 30,000. So where that gain will be adjusted, or if it was ulta, where that loss will be adjusted, parent company's profits. It will be adjusted in parent company's profits. If there is a gain or loss on cancellation, adjust parent, that is holding companies, parents P&L. Okay. Then very important as well as very frequent, pre-acquisition dividend wrongly credited. Pre-acquisition dividend wrongly credited. That is subsidiary company declared dividend out of pre-acquisition profits. So previous year dividend before for the what is pre-acquisition dividend? Dividend received for the pre-acquisition period. Dividend received for the pre-acquisition period is pre-acquisition dividend. So what is the treatment of this pre-acquisition dividend? The correct entry when you receive pre-acquisition dividend, if subsidiary declared dividend after the date of acquisition and holding company happened to receive that dividend, but that dividend is relating to pre-acquisition period, the entry that you should have passed is bank account debit to investment. That pre-acquisition dividend is a capital receipt. Pre-acquisition dividend should be considered as a refund or recovery from the cost of investment. So bank to investment is the journal entry, bank to investment. But they would have passed bank to P&L, which is wrong. In most of the questions, they would have done bank to P&L. So this is the original or correct entry. This is the entry. The question says the holding company has credited the dividend to P&L. So you need to pass rectification entry. P&L debit. Which P&L? Parent company's P&L. Because parent company only credited it to P&L. So parent company's P&L is to be debited. Consolidation of reserves when you do, parent company's P&L is to be debited, deducted. And while calculating cost of control, goodwill or capital reserve, when you calculate goodwill or capital reserve, cost of control, deduct this pre-acquisition dividend. Okay. And when you identify this capital profits or pre-acquisition profits, question always says this is the pre-acquisition profit, this is the total profits on the date of acquisition. Deduct pre-acquisition profits, pre-acquisition dividend should be deducted or is to be deducted from the opening profits. Pre-acquisition dividend, opening profits, from that you need to deduct. When you do the identification of pre and post, pre-acquisition profits, because from the pre-profits you have already paid dividend. So deduct from the pre-acquisition profits of subsidiary. Subsidiaries pre-acquisition profits should be reduced. Holding company, pass the wrong entry, do the rectification. So where are the effects of pre-acquisition dividend wrongly credited? 1. Deduct pre-acquisition profits of subsidiary. Okay. Then 2. Deduct pre-acquisition dividend received from cost of investment while calculating goodwill or capital reserve. Then deduct from parent company's P&L. So these are the steps to be done. Okay, these are the steps to be done. If there is a pre-acquisition dividend wrongly credited, subsidiaries profits, pre-acquisition profits have gone. Okay. Parents P&L is to be reduced. Parents cost of investment also is to be reduced because we are passing the rectification entry P&L to investment. P&L to investment. Okay, fine. Then bonus issue by subsidiary company. Then the next one is bonus issue by subsidiary company. Subsidiary company has issued bonus shares in the current year. So subsidiary company has issued bonus shares in the current year. That bonus shares can be issued out of pre-acquisition profits, or bonus shares can be issued out of post-acquisition profits. If bonus shares are issued out of pre-acquisition profits, whether pre or post, the journal entry of bonus issue is reserved to share capital. Journal entry is reserved to share capital. So reduce reserves. The journal entry is reserves to share capital. Reserve you need to reduce because pre-acquisition profits have reduced. That reduction is to be done when you calculate the capital profits or pre-acquisition profits. In step 3, when you do the analysis, deduct pre-acquisition profits. Okay. Then when you calculate goodwill or capital reserve, cost of investment minus pre-acquisition dividend, then you take share capital of subsidiary. This revised share capital, new share capital is to be taken. Minority interest, we give the share of subsidiaries share capital, you should take the revised share capital. Are you clear? Yes. Then if bonus issue is made out of post-acquisition profits, so you do the analysis, identifying pre-acquisition, post-acquisition profits. Always the journal entry of bonus issue is reserved to share capital. Reserved to share capital. So reserves should be reduced. Post-acquisition profits are to be reduced. Okay. Now give the effect of share capital. Give the effect of share capital in cost of control and minority interest. But remember, when you increase the share capital out of post-acquisition profits, when you increase the share capital out of post-acquisition profits, the goodwill or capital reserve, which you have already computed, if you are using post-acquisition profits for bonus issue, the goodwill or capital reserve, which you have already computed, will change, because that share capital is not out of pre-acquisition profits. Share capital increases out of post-acquisition profits. So the goodwill or capital reserve computed in the previous years will change. So if bonus issue out of pre and post will not result in the same amount of goodwill or capital reserve, will not result in same amount of goodwill or capital reserve, which is already explained in. So whether you do bonus issue out of pre-acquisition profits or post-acquisition profits, it will not result in same goodwill or capital reserve. So that is explained in illustration 9. You should go through. We have already discussed this in class. Please go through. It will not result in the same amount of goodwill or capital reserve. Okay. Then, very important, very important. What if bonus issue is already accounted? If the question says bonus issue is already accounted, which is explained in test your knowledge question number 10. What if, so very important, what if bonus issue is already accounted? Subsidiary company issued bonus shares in the current year and it is already accounted, which is explaining in test your knowledge question number 10. Then be careful while computing shareholding pattern. Be careful while computing shareholding pattern. Be careful while computing shareholding pattern. Number of shares purchased. Always be clear. Number of shares purchased divided by number of shares in the balance sheet. If you do just this, if you do this divided by this, will not get the correct shareholding pattern. You by the end of the year, you also would have received bonus shares. So take this, both number of shares purchased plus bonus shares received divided by total number of shares is equal to the shareholding pattern. Be careful with the shareholding pattern. Okay, so that's it. What about shares acquired during the year? What about shares are acquired during the year? What if the shares are acquired during the year? If shares are acquired during the year, say for example, April to March is the accounting year, and shares acquired on, say for example, June. Then what you should do? Then whatever profits in on or 1st April, profits will be given. That is pre. Whatever profits are there on 1st April is pre. And you need to normally opening pre during the year. During the year we take it as post. But remember, during the year up to June will also be considered as pre. And profits after June only post. Profits after June only will be considered as post. This additional or reversal of depreciation, unrealized profits of subsidiary always will be adjusted in the post acquisition profits. Okay, shares acquired during the year. So what is written regarding minority interest? So minority interest, there is a point which you need to remember. Minority interest, how do we calculate? Minority interest, subsidiary companies share capital plus share of capital profits, pre-acquisition profits, plus share of post-acquisition profits. But if subsidiary company is making losses, minority interest balance cannot be negative. Minority interest balance cannot be negative. It should not give a minority interest balance cannot be a negative balance or a debit balance. So if there is debit balance for minority interest, then that debit balance will remain as unabsorbed by minority, which is to be taken by holding company, which is to be absorbed by holding company. So minority interest balance cannot be negative. So if the share of losses is exceeding the carrying value, then that difference should be treated as unabsorbed loss. So the difference should be treated as unabsorbed loss, and minority interest should be shown at nil value, 0. And subsequently, if subsidiary company makes profit to the extent of the share of the loss, that profits should not be taken over. Only if the share of profit exceeds subsequently beyond the amount of unabsorbed loss, only that can be taken over. Okay, so far what we have discussed, what is the adjustment of revaluation? Revaluation is always pre-acquisition and depreciation is always post. Unrealized profit, there is upstream, downstream. If unrealized profit is upstream, subsidiaries profits should be reduced. Downstream, holding companies profits should be reduced. And from the balance sheet, stock has to be reduced. Mutual owings, adjustment is in the balance sheet, reduced from the liability and asset. Pre-acquisition dividend, always it would have been wrongly credited. So pre-acquisition dividend reduced from subsidiary companies, pre-acquisition profits, and the holding company has wrongly credited to P&L. So take it out from P&L, so debit. And what is the correct place? Reduce from investment. Bonus issue, out of pre-acquisition profits or post-acquisition profits, entry is effect is reserved to share capital. So give the effect reserve. If it's from pre-acquisition profits, reduce pre-acquisition profits. If it is out of post, reduce post. And increase in share capital, the effect is always in minority interest and cost of control, goodwill capital reserve calculation. Then minority interest can never be negative. If the share of loss exceed the carrying value, that will remain as unabsorbed, which is to be absorbed, which is to be taken by parent company. Subsequently, if the share of profits exceeds the share of loss, then minority interest can be shown credit balance. Then if shares acquired during the year, there is opening pre-acquisition profits and current year profits. We conveniently assume that profits are earned evenly throughout the year and divided between pre-acquisition and post-acquisition. If shares acquired during the year, opening profits are anyway pre-acquisition and profits earned during the 12 months, we conveniently assume that profits are earned evenly throughout the year, and profits attributed to up to the date of acquisition will also be treated as pre-acquisition, and the balance only will be post-acquisition. So these are the major adjustments while preparing the balance sheet. Thank you. All the best.